Hello, everybody out there. Warm welcome to everyone who's joining us for today's bar chart webinar. My name is Jean Baker, and I'm going to be your moderator today for this session that you've joined on learning about how to trade using multiple time frame charts. As you know, technical traders, we've been using charts for ages to analyze market data and to try to pinpoint the best entry and exit positions for our trades. And today we are going to get some great tips and learn some techniques from John Rowland, bar charts education specialist. He's going to show us how to look at the big picture as you analyze your charts. Hi, John. How are you today?
Hey, Gene, how's it going?
We're doing great over here. How about you?
I'm doing really good. I'm really excited about today's seminar. This is one of the skill building tools that I really rely on. So I'm really excited about to share it with our folks
Well,
today.
we're excited too. So let me tell you a little bit about John and the expertise that he's bringing today to our session. John's been our keynote presenter for the last series of webinars that we've run, and you're going to see that he's going to bring a unique trader's perspective on how to best use the tools on the bar chart website to your advantage. John's an ex-floor trader. He worked many years trading primarily the energies markets, and he recently joined the bar chart team in the role of our financial markets educational consultant. Whoa, that's a mouthful. And John is here today to share some of the things that he's learned over the years. Now, before we get started, I've got a disclaimer up on the screen, and I do need to remind you that today's webinar is being run for educational purposes only. And the information that John's going to be presenting today is not a recommendation to buy, sell, hold, or trade securities or any other investments. Your decision whether or not to make a purchase should be based on your own due diligence and not on any representation that we're going to be making to you. So with that, I am going to turn the screen over to John, and we're going to learn about using multiple time frame charts.
Okay, great. So multiple time frame analysis. What are we going to do with this? Well, what it's going to do is going to help us to look for or look at the big picture in terms of our trends and in probability. What we'll do is we'll look at prices. Is it relatively high or is it expensive, or is price relatively low or cheap? We can also use multiple time frame analysis to help us to identify potential roadblocks or speed bumps in our path to profitability. When we look at that range of price at these higher time frames, this is where we're going to expect we could expect potential trend reversals. It's also going to give us a better understanding of where we should look for areas of interest that will provide us with lower risk entries, which is really important for us as traders, but also how to look for a greater profit zones. In other words, maximizing our profits. And when we do our trend analysis in these multiple time frames, we're going to try to discover where we are in the phases of our trend. Are we in the impulse phase, or are we in the corrective phase, right? So, when I was in the classroom and I was working with a lot of junior traders, and when I mean junior traders, I mean those who are learning the craft, the skills of becoming a trader, but just don't have that experience, I was always amazed that they all did their time analysis or trend analysis on one chart, and especially micro charts, charts I would consider of lower time frames, like a minute chart. So for instance, here I have a daily chart of the SPY, the S&P 500 Spider Index, and I'm on a daily chart, and I'm in a 5-minute time frame. And a lot of times, my students would say to me, I'm buying this market, right? So let me just do this first. Let me see a show of hands, those of you who are in here watching, just a show of hands. Who's ever bought a stock and you've done your analysis, you bought a stock, and the minute you bought the stock, price went down? or you did your analysis, the market's in an uptrend, you love this stock, and as soon as you buy it, you swear the market knows that you bought it and the price goes down. So, I mean,
Okay, we have lots of people saying, of course, yes, that's me, I did it, been there.
and trust me, my hand is up too. So yeah, that is, one of the things as traders, we need to overcome. So what do we need to do? Well, when I talk to these junior traders is, did you look at the bigger picture? Did you take a step back and look at what is happening to your price? So here's a day chart. Now, we do see where price stopped going up here and went down, right? But if I just look at a little bit higher time frame, right? Now I'm looking at 5 days, right? And I can see over 5 days, why did price stop at those different spots? Well, it ran into resistance, a speed bump, or a roadblock, so to speak, right? Here was another area of resistance that price bounced off of, right? So why did that happen? Well, because we had that resistance in our time frame analysis. So what we want to do is we want to look at a bigger picture, right? So we want to look at bigger pictures. Why did price stop going up here, right? Here we can see all of those purple lines that we saw, those zones, right? We're up here in the area which is very high in our price. Not high in our price, but the all-time high of this price. So this was an area where price paused for a moment, right? So then students might say to me, well, I'm looking for some trading opportunities, and now I'm afraid to buy this market, right? Because it keeps bouncing off of these supportive, resistive areas. But here it goes, broke through, and it broke through very solidly, and it ran in a very fast manner. So why did that happen? Why is that reasoning for us? Well, because when we look at the bigger picture, we didn't have any resistance, right? We had a free space, clear air, less the path of least resistance. That was what allowed our price to continue to go up. But if we look at this time frame analysis, again, this is the S&P, why did the price stop going down? Why did price make a bottom during the crash that we had early in the spring? Again, what I might have to do is I might have to go to a much higher time frame. And what I'll discover is that this price movement where we made the bottom is just where price returned to the area of where our trend, our much higher time frame trend, began, the origin of it, right? And that's what this is really is in trend analysis. When we start doing our trend analysis, this is just the correction to an impulse. Now, I know for us, to say that, back in March, when the market fell as far as it did, to say that was a corrective move, well, that is a hard pill to swallow. But here we do see that where did price stop going down? Well, it's back to the origin of this mega trend that goes all the way back to 2017. So what I did was for this webinar is I kind of thought about what stocks I want to look at for you guys. And what I did was I went into Google and I Googled the top 10 holdings of ETFs and the top 10 holdings of Robinhoods. And my thought was that, ETF holders are more conservative. They're looking for more of a balanced portfolio. So those ETFs that hold those stocks would be more of a conservative trader. And Robinhoods are these new traders that are out there. And these Robinhood type traders are I would say more momentum traders, or they're looking for, price action now, so a little bit more aggressive, or risk takers, right? And what's really kind of surprising is that there was a lot of overlay between a handful of stocks overlay between these two different groups, and they're pretty obvious which those overlays would be: Apple, Amazon, Facebook, Google, and Microsoft, right? But there also were other ones that I thought were kind of unique, where you would think our Robinhoods would be an aggressive or more risk taker, and actually Ford Motors and a General Electric were in the Robinhood sector. So that was kind of interesting to me. But let's go to Microsoft for a second. And let me show you how we're going to start doing this multiple time frame analysis. So what we want to do is we want to start at a very high time frame. Now, if I'm going to be trading stocks, I think, at least a year, maybe 2, 3, 5, maybe we may even have to go out 10 or 20 years to get a greater perspective. Now, I'm going to talk about what these blue lines mean in a second, but what we're going to do is we're going to look at current price. And we're going to start there. And what we're going to look for is recent pivot lows or swing lows. And when I mean a swing low, it means where price stopped going down and started going up. And we're going to look for swing highs. Now, in Microsoft right now, it's difficult for us to find a swing high because price is still going up. It hasn't come down. And right now, our swing high is actually our ATH, our all-time high, right? But since this swing low, which occurred in March, which is about 6 months ago, now what we're going to do is we've defined the range of price in terms of what is low and what is high. And you can see that right now, current price, we are extremely high in this range of price between March, our swing low, and the swing high that it's going to be set either today or tomorrow or 3 weeks from now or whatever, but in this range. So this has happened over the last 6 months. So now I'm going to look at my 6-month trend. What is my trend? And when we look at trends and we think about the concept of trends, trends are really just a series of impulses and corrections, right? Impulse, corrections, impulse, corrections, impulse, corrections, impulse, corrections. And what defines an uptrend is higher highs, impulses, and higher lows, corrections. And if we look at our 6-month trend here, we can see that our market is in a classic. I mean, if you went to, a dictionary and you looked up uptrend, I mean, this would be a picture of an uptrend, classic uptrend, where we're continuing to make a higher high on an impulse and a higher low on a correction. Higher high, higher low, higher high, higher low, higher high, higher low. And you can see right now what is going on in our market is we're in the impulse segment of our trend. That's a good thing. Our trend is continuing to go, and we're making a new high. Excellent. That's what we want to see. But for me to step in and buy right here, right? Think about that example I showed you in the SPY. We could be buying after an extended price movement. And what we might want to do is wait for the correction. And that's where we're going to use timing and multiple time frames analysis to help us find a better entry, less risk. If I buy right here at time frame, right, based on this, where is my risk to the downside? Well, my risk is to the downside is where my trend would break. So I'd have to risk all the way down to here. And that might be $20, $25. That might be too much risk for me to take. But if I'm wait and patient, wait for price to correct, I might find an entry. I might find an entry that is lower, where I'm using my swing low as my risk assessment, where I could come in at a cheaper price, maybe down here where price impulsed away, or down here where price impulse away. Now my risk is a lot less, right? I'm in the impulse segment of my trade, but I want to wait patiently for that correction, because I know that if I'm in an uptrend, there will be a correction to come. Now, we'll look at an example of why I might be able to take this trade as we impulse away from a significant high. In this case, this swing high was our recent all-time high. And we'll look at some rules that we can do that. But at this moment in time, what I want you to kind of understand is now we're looking at these higher time frame trends to tell us, hey, we're in an uptrend, but let's be patient and look for those corrective moves, right? So even if I go to a lower time frame, let's say 5-minute time frame, 5-day time frame, here I'm looking at that impulse, right? There's that impulse, right? And here is that correction. Now, if we did that zone there, that area where we might wait for that correction to come back, you could see that our market did give us an opportunity to take this trade, to come back into this trade. And then what did price do? Well, it impulsed away, and now we need to wait for that correction. That correction entry we can find. We're going to drill down into a lower time frame to find that trade. Now, what most junior traders, they make that mistake, right? They come in here and they say, oh, price is broken out, and now they're buying right here, right? They're buying at the top of the market because prices are relatively high or relatively expensive, and they're not taking that time to wait patiently. And so part of learning to be a better trader is learning to be patient and not get emotional or have that fear, right? That fear of missing out, right? Okay.
So John, if I can interrupt for just a moment, we have a number of people asking if you can use candlestick charts instead of the standard OHLC chart that you're showing.
Yeah, great question. And excuse me. Yeah, I love candlesticks. Oh, hang on a second here. Excuse me, my COVID is getting bad. That's a bad joke.
No.
No. So up here in this little left-hand corner, yeah, we can change our bar chart, our standard open, high, low, close bar chart, and we can come down and look at candlesticks. There's different types of candlesticks here, but the classic candlestick is what we call the open to close candlestick. And what's nice about these open to close candlesticks is they kind of gives me a picture of momentum, and that's really what I want them to tell me. If we have an opening price and then our candle, whatever time frame we've designed the candles in, it closes above the opening price, then the candle will be a green candle telling us that price went up. If we have an opening price and it closes below the opening price, then we would have a red candle. It's telling us that that candle, that price action in during that time frame, price went down. And so what we can see here is we can see little moments of momentum inside of whatever time frame that I'm using. For instance, I'm in a 30-minute time frame, so each one of these candles represents 30 minutes. So it's kind of telling me the momentum of the market inside of that 30 minutes. Now let's go back and look at, those two zones that we were kind of playing for. And here you see we have that impulse, right? Price went up, and then we had that sideways or corrective. Price actually went down, and then we had another impulse, a series of up candles. So this is where we want to start looking for potential entries. Now, let me go back to my 6 month, right? And that zone, right, you can see is right here, this impulse correction impulse, and that is probably going to be a good zone moving forward. But until the market broke out, we can see that we might want to be patient and wait for an entry that is in line with my trend, which is maybe a little bit lower, where prices is relatively lower, where I'm going to get a better value or cheaper value. And you can see that I just have a trend line here. I have around 207, 207.40. Again, if I go to my lower time frame, this is where I'm going to drill down, right? I'm going to drill down and look around 207, 207.40. And there is, right in this area right here, 207, just below 207.40. Here is an area where price stopped going down. That was our swing low. And here's that impulse, right? That impulse that not only impulsed up in price, but it took out a previous swing high. And this is where we would be looking for a more less risk probability entry trade. And if you think about it on this trade, my pivot low, right, I'm not risking as much. I'm only going to risk maybe $4. If I took an entry up here, yeah, I can find ways to reduce my risk based on the candles that I'm looking at. But if I'm believing in this trend, I'm still have to risk this swing low. And now what we're going to say is, well, how far could price go? Where would my target be? And so if I come in here at around $2 or $212, and my new swing high is $220, well, that is only about $10 worth of profit based on a risk of $10, right? 212 versus 202. So now I'm risking $10 to make $10, a 1-to-1 ratio. Probably not a good trade. I would hope for most of you, you would start thinking about looking for some greater risk reward ratios. I like to personally look for at least 3-to-1 or better. I actually kind of look for 5-to-1s or better because it's a lot easier to get 3-to-1 out of a 5-to-1 trade. Now, I could use this little price action right here, come in around, $212 and stop myself below $211 or $210.88. That would lower my risk. But notice now I'm putting my stop in an area where my trend is still going up. I want to be putting my stop in an area where I believe my trend is now going to be going down. So here's where we can drill in to find better zones, but also to help us manage our risk as well. All right, so let's go back to our higher time frame. All right, and what we do see now for today for Microsoft is we are in this impulse stage and we have broken out above our all-time high or our swing high. So this is going to be difficult for us to figure out where we're going to do our multiple time frame analysis based on a swing high. So this market, right, for us is actually a market where we're probably going to have to wait a while here. We're going to wait for that price action and wait for that correction moving forward. All right. So the other thing that let's go back to well, actually, let's do this. I've been showing you all this price action inside of the interactive chart, and I really like to come inside of the dashboard. Now, before we go to this market, I want to go back to my watch list. Here's my watch list of all my stocks that I found in that top 10 ETF and Robinhoods. And one of the ones that I noticed was JP Morgan. And why I wanted to look at this one, JP Morgan, was, this is a financial stock, right? And old school analysis of market says that, usually when the market makes a low or the broader market starts to appreciate, it's usually led by financials and technicals. And certainly in the last 6 months, our technicals have driven the price of the broader market. But I wanted to look to see what's going on in my financials, because if we're going to get another leg out of the S&P or our broader market, we really want to see our financials doing well. So I've done my analysis here with my financials, and I'm doing that. And what I do discover here is, again, I'm at a 3-year of JP Morgan, is, yeah, this is kind of showing me that the JP Morgan is in an uptrend, but it's kind of schizophrenic here, isn't it? It's showing me this cycle of higher lows, which is one of the components of an uptrend, but it's also showing me a cycle of lower highs, which is a component of a downtrend. So my higher time frame is showing me that our price is actually kind of range bound, and not only range bound, but it's starting to go sideways, sometimes referred to as coiling. Now that could be a good thing for us, because many times when our market comes into a coiling, it's about ready to break out one way or the other. All right. So here I'm looking at the higher time frame, but we said we want to look at multiple time frames. So one of the tools that we have available to us is up here where it says grid. And we can find the grid in the interactive charts as well as in the dashboard. And we can look at 2 different time frames side by side or on top of each other. But I like to look at multiple time frames. And so what I've done here is I've put in multiple time frames. Here is my 3-year. I'm using a weekly, right? And you see that my higher time frames, we're going to be looking at weeklies or maybe monthlies. And what's going on in my weekly? Well, I like my weeklies because I believe weekly highs and lows are very significant in my trend analysis. And so we can look here and we can see that, we are just made a weekly high up here, a pivot high around 106, and we've just made a pivot low around $94, $95, right? So where price stopped going down. Actually, we could go all the way down here if we wanted to do that. But this weekly low over here would probably be more significant to us at this moment in time. Here is my daily chart, and 1 year daily. And again, you see that we have that slow uptrend, right? But we also see the remnants of a downtrend. Okay. Here is our 3-month, a daily chart. Now I could change that to below 1 month on an intraday basis if that's what I want to do. But I like dailies. I really believe in dailies. And again, you do see this slow moving uptrend, but what are we not doing? We're not making new highs. We're not impulsing to new highs. We are impulsing, but we're not really making any new highs. So this gives us a cautionary tale. And then here is our 5-day, right? And if we look at our 5-day, right, we do see that we had a downtrend here that price has now broken out. Now notice that I have studies I can use, but not like in the interactive, or if I went back to my non-grid, one of the things you'll notice is that I don't have any tools for me. And certainly one of the tools I like to use is my trend drawing tools.
Right. Speaking of that, John, so I have a user asking if you should be using moving averages to look at the grids, or are there any other momentum or trend confirming studies that you like to use?
Yeah, exactly. So great question from our subscriber there. Yeah, so one of the things that I like to use is moving averages, and that is definitely one of the trend confirming studies that I like. Now, we do have a lot of different moving average studies, and it depends on how you like them. Exponential, where we're looking at a current price might be a little bit higher weighted, but I'm just going to do a simple one. And one of the ones that I do like for stock analysis is a 20 period, and especially when I'm looking at daily charts, daily 20-day moving average. I really believe in that is a great moving average to look at. But moving averages are kind of fluid trend lines. And so the theory of moving averages says that if price maintains or stays above the moving average, that is confirming that you're in an uptrend. Or if price is below our moving average, that is confirming that we're in a downtrend. And one of the things I like to do is I like to wait for my price to engage my moving average. And then when it does engage my moving average, that floating trend line, that might signal to me an area where I want to start investigating for potential entries so I can re-engage my trend. Now, just remember that if you're using a moving average and you're in an intraday time frame, your moving average is not a 20-day moving average. In this case, this intraday moving average would be based on 30-minute candles, right? But here we are in a daily, so we do see a 20-day moving average, and you can see that here's where price fell below or engaged our moving average, and that was an opportunity for us to look for an area of probability for us to buy, right? Remember, we talked about an impulse correction impulse area, and there it is right there. That would have given us a nice entry in this market after our impulse correction, right? Here is the origin of that last impulse. So when I'm looking at my time frame analysis here, what's going on? Well, 3 years, my market has been down, and now it looks like it's starting to change on a weekly basis, and it's starting to slowly crawl out. My daily, yeah, I'm starting to show the moving average is starting to show higher highs and higher lows. So it is starting to tell me that we're in an uptrend. In my 3-month analysis, well, we're probably kind of making a sideways action, but I could look for zones that are in low, relatively cheap, to have an opportunity to buy, or I could look for zones that are high or relatively expensive to take a short. And if I look at my 5-day, right, we have just recently broken out of a downtrend, and we've now had an impulse, and we have a correction that is below our moving average here. So that could be a cautionary trail. We really would like to see our price to get above there. So what am I going to do? Well, I'm going to look at this intermediate time frame over here on the right, and here is my swing high, right, of 106.13, 106.30. And what I'm trying to guess now is if I'm in an uptrend, I need to see an impulse above my most recent swing high. So what I'm going to do is I'm going to set an alert. And I'm going to come in here and click on alert. And I can have this set to me on an intraday, but because this is at a daily level, I'm probably going to do an end of the day alert. And I'm going to select what type of alert I want. Well, I want to talk about price, right? And I want to know a high price. In this case, my price over here, 106. Right? And what value, I want to know when price gets above, greater than that value. And that value, I could refine it down to the actual very high. But, sometimes what I like to do is I like to set my alert just a little bit in front of my most recent swing high or swing low so that I have time. I can get the alert and have time to set up that trade, especially for your day traders, right? Now, where do we want to look for a buying opportunity? Well, here was that downtrend. Here was our impulse, right? And now we are getting our correction. So where was the origin of this new trend? Well, it was way down here where price broke out from that downtrend and impulsed away, right? So impulsed away. So I will be patient and look for an opportunity to be a buyer somewhere down here around $98, or maybe I could even come to the top of this former pivot high, 98.50. And again, I could come into my alerts and set an alert based on price. But this time what I'm going to do is I want to look when price is low, and I want to make sure that it's lower than, and what do we say it was, around $98. All right.
So John, you're using the alerts for setting stop or limit levels. Is that correct?
Yes. I'm waiting for the market to break out. Remember, we looked at this. Let's go back to our non-grid. And let's go to 6 months because it'll be a lot more obvious to us. What I'm looking for, Gene, is I'm waiting for price to break out of this recent swing high, right? I want this impulse, right? If this is an uptrend, I want this to impulse away, right? I want to know that it's gone above, and that would give me an opportunity to look for an entry on that correction. Or because I believe this is an uptrend, I'm going to wait patiently for where price is low in my range of prices that are significant to me at this moment in time, this trend analysis. Now, one of the other things that we can do in our studies, not only our moving averages, but there is a tool called Bollinger Bands. Now, some folks like Bollinger Bands, some folks don't like Bollinger Bands. I like Bollinger Bands, but I want to look at Bollinger Bands at much higher time frames, where at least my candles are at the daily level. And I'm going to try to avoid looking at Bollinger Bands at what I would call micro or intraday levels. But here we see Bollinger Bands is a 20 period, and the width, which is called the standard deviation, is 2 standard deviations. And those Bollinger Bands fans would know that you can change that. But the standard or the industry standard default is 20 periods and 2 standard deviations. And what we're going to look for is there's a couple things that we can use these for. First of all, it helps us identify potential trends or momentum in the market. And what we're going to look for is when we get our impulses, right? If we get an impulse where our candles are going outside of our standard deviation, in this case, the outer bands, that's kind of telling us that our impulse has gone too far and that we're getting ready for a corrective phase. If I'm in an uptrend, I want to look where prices are relatively cheap, right? Where we engage my trend, here's my trend, but also where we're low in the Bollinger Bands, where price has gone too far, too fast to the downside in an uptrend. So outside the Bollinger Bands is telling us that price has gone too far and that we can expect price to revert back to the mean, our 20 period, or it can tell me that the momentum of my market, right, as I move from low to high, in this case, this trend, or from high to low, where I want to be looking for trading opportunities. One of the cool things about using the Bollinger Band and the 20-day period or the 20 period for the mean is now what I've done here is I'm going back to my studies, and let me put back in our moving average. And notice what happened. We put in the moving average and it's right on top of the mean of the Bollinger Bands. Now, inside of the dashboard, when I go inside here and I'm adding studies to my chart, I can only put in 3 studies, right? I can only use 3 at a time. So if I'm using a 20-day moving average and I'm using Bollinger Bands, I'm using 2 studies. But what I'm really doing here is if I eliminate the 20-day moving average, and I just use the Bollinger Bands, then I know the mean, the middle line, is the 20-day moving average. So I'm getting two analyses for the price of one, which is pretty cool, right, Gene? So
That's right.
I can add another study, and one of the studies I like for stocks is a moving average of 100 days, just a longer period of time. And what we're going to do with this is, and this is kind of cool, we want to start finding areas where we find impulses or corrections where our zone of interest falls between our 20-day moving period and our 100-day pulling back. I kind of call this the bull zone, right? If I was in a downtrend, that would be my bear zone, right? And you can see that here we do see where price stopped going down, based, and then went up. And so this down here would be an area where I want to look for a potential entry. And again, notice that price is down around 97.37, 97.50, below that 98 value, which we looked for based on our most recent pivot high or pivot low, right? So where is that? That looks like it's right in here, where my price based out, right? Okay. So let me check my notes, make sure that I tell out everything I want to tell you on that one. Okay, so yep, we set our alerts, we looked at the right zones. All right.
John, if I could ask you a question, because this is coming up a lot from the people who are sending questions in. How are you setting those dotted horizontal lines? Can you show us a quick demonstration on how you set those up?
Yeah, sure. So let me do that on another market so we can move forward. But so here's my a list of stocks, and the one that I was curious about is Exxon Mobil, right? And so we looked at the S&P, we looked at JP Morgan, which was kind of a sideways market, and so here is how I can find opportunities in other markets besides markets that are going straight up. And this is the Exxon Mobil. And again, I'm in a 6-minute time frame. So I can come into my tools here, and we do have ways to draw different lines. We have vertical lines, we have trend lines, we have rays, we have horizontal lines. And so that's basically what I'm going to do. I'm going to set a horizontal line, right? And just have to tap it. Now, if I want to change the color or make it thicker or thinner, right? Or I want to change how it looks, short dashes or dash dots, dot dash, if you know Morse code, that's probably a word, I don't know, maybe. That's where we can make those adjustments. Okay, so let's talk about Exxon Mobil, right? Now, Exxon has been around for a long period of time. So let's go back to 10 years. And if we go back 10 years and we look at what is going on with Exxon Mobil, we can see that, prices have fallen dramatically in Exxon over the last few years. And if anything, we can see that this downtrend has really kind of accelerated during this year. That's what we are looking for in terms of relative prices. Now, if I look at what's happened in the last year and I use that technique where I'm going to start at current price and I want to find my most recent pivot low or pivot high, well, then that would be, whoops, let me grab this. That would be my range of price. And you can see that right now in this range of price, we're probably right in the middle. But if I go down to, let's say, the last 6 months, well, my pivot high hasn't really changed much, but now my pivot lows have come up. and we are relatively cheap. Now, why did I pick Exxon? Well, some of you might be realized or haven't noted this, but the Dow 30 index has decided that it wants to rebalance the Dow 30, and it's going to take Exxon out of the Dow 30 index and replace it with Salesforce, right? So what does that mean? Well, anybody who has an index or an index manager who has used the Dow as part of the tracking of the Dow 30 doesn't need Exxon anymore, and so they're going to have to sell out of Exxon, which is telling me that there's going to be institutional selling in this market, right? And that institutional selling, now they're just not going to jump in and get out in one day. They're going to sell over multiple days or weeks or even maybe months. But I know that from the next 3 months, there's going to be selling pressure on this stock. So anytime this stock rallies, maybe it'll rally in sympathy with maybe the crude oil market, that might be an opportunity for me to take a short position. And you can see here that just recently, since that announcement, right, 2 days ago, prices have fallen. Now, what I find here is, yeah, we have fallen into an area where we can consider low in this range of price, which might be on a buying opportunity. But here's the difference than what we saw in the last two examples is we're not in an uptrend, we're actually in a downtrend. So that would give me caution to be a buyer here. And if I look at the path of least resistance, which way does the market feel like it has more potential to move? I see a lot of resistance above my head. I see a lot of selling above my head, but below this $40 mark, really we could see that prices could fall, down to $36 or maybe even as far as $32. Now, what I think is happening with Exxon is that it's holding its value because of its dividend. And you can see that the dividend on Exxon is a very, very frothy 8.5%. That's a huge yield, and that's large. That's more like a yield that you would find in a very stoic market, like let's say a utility. So is Exxon becoming a utility? Maybe it is. But if Exxon is out of the Dow 30, maybe then those at the Exxon, the president has said that the dividend is safe, but there's no obligation now because they're probably holding that dividend high. They might, I'm not saying they're going to do this, but they might cut that dividend to help protect their market or their business, right? To protect them. So could I buy Exxon on the cheap? Yeah, I could, but my trend is still down. So I'm going to need to wait for price to stop going down before I'm going to buy this one. But in the short term, I'm more inclined to look for opportunities to sell this market when it rallies here. So we would be more cautious. Now let's look at a much higher time frame. Let's go back to a 5-year weekly. Let's even go back as far as we can go. And gosh, you can see that the last time we fell down here where we made that swing low around $30, that was in reaction to where price started this whole big trend before. And this $40 area is kind of a crucial area for Exxon, and that below $30, the next area where we can anticipate price maybe to hold this last impulse that goes way back to, I don't know how far do we have to go back to 1997. That value is $22. Now, I don't think we'll get there unless they do cut the dividend, but for somebody who is playing the market from the short side, path of least resistance, this market has a lot of room to the downside. All right, so let's look at one more. I see the hand on the clock is getting running a little bit late here. Oop. And everybody's favorite, whoops, a papal apple.
My favorite.
Yeah, exactly. Oh, not Apache. Fat finger. That's what that's called, guys, when you do that. Okay. All right. So let's go to our dashboard. All right. We'll change our dashboard to Apple as well. That would help too. APP. Oh, I always do that. I don't know why. I think it's
That's because that's how Apple is spelled, APP.
Okay, so we looked at the S&P this morning, and in the first example where we broke out, Microsoft was breaking out of a pivot high or a more recent swing high. And so one of the things we can think about is when we break above a swing high or swing low, depending on what we're going to look at, we can start thinking about taking that trade, that momentum trade, as it breaks out. Now, one of the things we like to see is we want to see our market base at a pivot high and then break out, or in this case with Apple, we want to see a major breakout, not only a major breakout, but a gap. And when we have a gap that breaks out above a previous high, that is a very bullish sign. In this case, that's telling us our momentum or our trend is going to continue, and not only continue, but it's probably going to accelerate. So we could just take that trade as it is. Now, again, you're going to have to use your own risk adjustments and how you're going to fill in, how you're going to assess the risk of this trade. But this is a technique sometimes referred to as gap and go, right? This major move is about to happen. But let's go back in time here, right? So before we had that breakout, right? And we're doing our current price and we're looking at our swing low versus our swing high, right? Where price stopped going up and started going down, right? And now price is starting to move higher, boom, boom, boom. Then we get a breakout. And so we're going to take that momentum trade. We're going to take that trade because it's broken out of a previous high. We're waiting for that momentum, that impulse of my uptrend. How far can price go? How far will this travel? I want to know a target, give myself a target to set my profit. Now, notice that in Apple, we had another gap up, another positive sign, and more green candles, more impulse motion, and higher we went, right? And eventually another gap up, and eventually we did finally find a red candle. Now, this could be our new swing high, but what I said to you is let's look at opportunities to tell us how far this impulse could carry. So one of the cool things we have in our tools is our Fibonacci's. And I've already drawn this based on my swing low and my previous swing high. And if I go back into Fibonacci, right click.
Yeah, John, this is great. I've had a number of people ask if you use Fibonacci's in your analysis.
Yeah, my Elliott Wave fans will know exactly what I'm showing here, but this is not magic, guys. This is really cool how this works. So here is my 0, 50, and 100. That's the ones that I've already clicked on. And then, here you can use your positive and normal Fibonacci numbers. But here's what we have, what's called the Fibonacci extension. So we're measuring our last move from our swing low to our swing high, and we're going to add our extensions, okay? That's going to predict how far price is going to go higher. Wow, look at that.
Wow.
This last red candle is that second Fibonacci extension. So if I was a trader who was trading momentum and I was looking for a target, that would have been my target. Or that would have been concern for me that if I am holding on to this position, where do I want to start thinking about taking profit? Now, notice that our first extension is also where price paused for a moment. Now, what other tool did I show you that can help tell us if prices are relatively too high or too low, and if prices momentum has overextended itself? Well, that was our Bollinger Bands. And again, this red candle was created, or part of it was created outside of our standard deviation, our 2 standard deviations. So these 2 indicators would have given me a better indication that, yeah, maybe Apple is going to go higher, but at this moment in time, that it's probably gone too far, and I want to wait for that correction. Now, where am I going to look for that correction? Well, remember, we talked about adding our 20-day and 100-day, right? Well, I know my 20-day is the mean, and my 100-day is way down here. So I want to find a zone somewhere between these 2 spots. My lower Bollinger Band is right here, and that is where we broke out. So somewhere's down here for Apple is probably where I'm going to get back into this. Somewhere's below, $435 and just above $400. So let's sum up here quickly, and we're going to go back to the S&P. All right. And let's go to about 6 months here. Actually, let's look at it a little bit longer. What do we use multiple time frame analysis for? Well, what's going to help us identify where we can find potential speed bumps or resistance or support in our analysis. It's going to help us define our trends, right? Our trends in all time frames. And is my trend in an impulse or corrective stage? And that's going to help us define better entries or better exits in terms of maximizing our profitability. Now, what I wanted to do with this is I wanted to finish with a cautionary tale. And before I do that, let's do this. Let's clear everything. Let's clear all our studies. And let's clear all of our tools, right? And I can clear all, right? And let me just kind of tighten this up a little bit, right? And we are breaking out. We are moving higher. But this market is a very rare market. Actually, I want to have a trend tool here. Unlike normal trends, right, we are making higher highs, but we're also making lower lows. So what does that tell me? That tells me that the S&P is in a moment of major volatility, and that, yes, we could see higher prices, and we probably will see higher prices in terms of momentum. But when prices reverse, there is a lot of room, or the volatility of this market tells me that prices could fall very quickly or in a large range of price in a short period of time. So that's the cautionary tale that I want to give you for the S&P. I'm not saying the S&P is going down. I'm just saying that this is a rare market, right? And that rare market where we're making higher highs and lower lows is a cautionary tale for us. So that's about an hour, guys. I wanted to kind of keep it right under an hour. I hope that you've enjoyed this discussion. put this tool to work. Start at a higher time frame and drill down. As you're drilling down, make sure you look at all your different trends, see where you are in your impulse or correction stage. And the other thing is, be patient. Look for the right opportunity, not chasing price or the fear or emotion of price.
Wonderful. Thank you so much, John, for your presentation, for your tools and tips, and all of the great information that you shared with us today. A lot of the things that John went through today, talking about interactive charts and dashboard and drawing trend lines, that is available for anyone who comes and uses our site. But I do want to point out that if you want the charts to save your trend lines so that they're there the next time you come back and look at them, you do need an account. And over on the top right side of the screen here, you'll see a sign up button. If you are not a member, we offer really two different memberships. There's a basic membership, which is free. All you do is you send us or sign up using your email address. We create an account for you, and then you can log in, save your charts, do all sorts of analysis and all of these multiple time frame analysis tools that John showed you. You can use dashboard. Now, one of the things that John did show you today is a part of our Bar Chart Premier subscription, and that's the grid charts that we looked at, where you can show up to four different time periods for the same symbol at the same time. If you're not a Premier member, we offer a 30-day free trial. So there's really no reason why you shouldn't go ahead and try to look at all that Premier has to offer, and there's a lot out there. So if you're not a Premier member, go ahead and give us a try. The other thing I do want to point out is we have a whole series of webinars, webinar archives. Again, it's under the tools menu. There's a free webinars page, and you'll see, oops, for some reason it's not showing up here, but we actually have just announced a new webinar that John's going to be doing next week. I can actually send all of you an email a little bit later on today showing you details on the webinar. John, why don't you tell us a little bit about what you're going to be doing next Wednesday?
Yeah, so we're going to revisit the futures trading guide. This is a new feature that the bar chart has had, and it's based on some moving averages. And what we're going to do is we're going to go inside here and look at how to manage a open position or manage trades, how to build a portfolio. So just to kind of give you a tease, guys, here. Here's my tools, and then I've created a portfolio over the about the last 10 trading days, 2 weeks, based on the signals that it's given to me. And you can see that I'm in a wide variety of futures contracts, but again, past performance is not indicative of future results, but you can see that we're up about $21,000 in about
Wow.
3 weeks worth of time. Now, most of it is in the NASDAQ, which is, the market is going crazy. But still, look at some of these results in some of these lesser contracts. Some of us who don't have a lot of capital to trade the NASDAQ, wheat, would be one of those examples. And what we'll do is we're going to go into some more expensive contracts, for instance, the NASDAQ or the S&P or gold, and look at what are called mini contracts or micro contracts for those of us who have less capital. We're not going to get these results in terms of total dollar values, but percentage-wise, we'll see the same results. So we're going to revisit this, and we're going to go into it and learn how to manage open positions, find better opportunities, and how to set our portfolio and the alerts to make my job a lot easier, so I don't have to spend all days in front of the charts.
Great. Well, we can't wait for next Wednesday. With that, I want to wish everybody out there good health. I hope you stay profitable in all your trades and keep coming back to Bar Chart for new ideas and new educational opportunities. Thank you very much, everybody. Have a great day.